Welcome to Stock Talk with Mike. Today I want to talk about a company that I've held shares in for about a year or so now, and that is Unity Software. They're known as being the 3D engine for game developers, for developing video games and developing over 50% of the games you see out there, whether they're mobile or console. But I'm going to talk about how they're actually a whole lot more than that, and they have a lot of optionality for growth moving forward. So if you like this kind of content, please consider subscribing to the channel and liking this video. So Unity is about a $30 billion market cap company and growing revenues about 30 to 40% annually. So definitely a high growth company. And most of that is coming on the gaming side, as I mentioned, being the go-to platform for game developers with their 3D engine for developing games and ads for games as well, and for other applications. But there's something that really is being looked into some of those other verticals that Unity is looking to move into that are still a relatively modest part of their business, but I see being big legs of growth over the next decade and more. So this is actually from the previous quarter. So they're actually going to be reporting earnings here again on Tuesday. I think it's August 10th, so that'll be coming up. But from their last quarterly report, they talk about some of these other verticals that they've been talking about for some time now, and I don't know if a lot of investors really picked up on this, but just reading here an expert from their highlights. New customers in household appliances, automotive, healthcare, aerospace, and government, as well as multinational retailer. They got Vertamed allows surgeons, physicians, and medical educators to train in risk-free virtual environments and simulations for different diagnostic and therapeutic procedures. So this is an example that they're involved in all these different industries now as far as developing with their 3D engine, developing all these 3D platforms and applications that can be used across all these different industries. Obviously like architecture and construction and education as well. So a lot of pieces here. This is a huge 3D virtual play as well. Unity and Here Technologies are collaborating to build the next generation of in-car experiences through embedded automotive human-machine interfaces with real-time 3D graphic capabilities. So the collaboration aims to deliver a new range of high-end dynamic mapping and infotainment experiences such as autonomous driving, simulations, city planning, and digital twin through a combination of automotive-grade map data and services with Unity real-time 3D platform. Again, so who would have thought that Unity would potentially be a play on autonomous driving and the infotainment systems within cars as cars become basically just computers, right? So Unity is even moving into this area. So this is an example of a company that is investing in their growth, investing in their development. That, companies like Unity that are these high-flying growth stocks get a bad rap for not being profitable, but clearly there's huge opportunities here to grow well beyond a $30 billion company as they explore these other verticals. Like in their last quarter, their revenue was $234.8 million, which was a 40% increase. And their create and operate solutions, so that's really on the gaming side, was the majority of their revenue. In green here I have strategic partnerships and other revenue was only $17.8 million of their 234.8. So only 8% of the revenue. So this is referring to those other verticals other than gaming. So a ton of potential here, a very small percentage, but they have the opportunity to put these tentacles out into a ton of different industries that they're currently not in. So I see this being a huge leg of growth forward for Unity. And you see this in their bottom line when you look at their income statements. This is from their Q1 again. So last quarter. So their revenue again was $234 million, but they operated in a loss, quite a large loss of $107 million. But if you look here, 65% of revenues, for example, was eaten up with research and development costs. They spent 154 on research and development. So they're investing huge back into the company. If that was down to 10 or 20%, a more reasonable level, you'd be talking about a highly profitable company. Sales and marketing was 69 million. So that was about 30% of revenues. So again, a typical value there you see in a more mature company is about 10%. You start looking at paring down those numbers and you have a highly profitable company. This is a software as a service company with reoccurring revenues that would deserve a high multiple. But you also, I really like to see this this investment in their growth and in their development right now. And that's how you see a $30 billion company become something much, much larger. Like, I think the perfect example is Amazon. I mean, they got a bad rap for years, right? When they first came public way back in 1997, they hit a low of, I think, $1.34 a share. And that put them at about a $676 million market cap back then. And over the years, I mean, that's a lot of years, right? That's over 20 years here. But it has grown in value over 2,500%, right? From $1.34 a share to today's price of over $3,300 a share, where they're a $1.7 trillion company. And even I remember, my dad was into investing. I remember, the news being on talking about Amazon when I was younger. And, I remember hearing the book market's not even that big. Their market's not that big. They're not even profitable. It's expensive. And they were investing. Meanwhile, they had their heads down. They had a highly functioning core business generating income, and they were investing in all these other fantastic growth opportunities that was going to drive the business moving forward and create the big beast that they were. If they focused on profitability when they were a book company, they would never have ever developed AWS, their huge revenue driver now, or moved into all these other areas of e-commerce, moved internationally. You're not going to see that kind of growth in a company that isn't investing in their own growth, or paying income, paying dividends to shareholders. So finding these high growth stocks that are going to have this exponential growth, chances are there's going to be some rough patches along the way. There's gonna be a difficult valuation periods where they're difficult to evaluate because they're investing so much in that growth. But you do just want to see at least the gross margins moving in the right direction and see that they are capitalizing on this expenditure in development. If they're spending all this money in development, they better have high growth rates, and in business segments that have at least a pathway towards profitability and that they eventually take steps towards it. So as I mentioned, they are going to be reporting quarterly earnings on August 10th. I don't ever really trade around earnings calls or try to time it that way. If anything else, I look for opportunities. If if maybe they miss, but the long-term prospects still look good, those sometimes create some buying opportunities. Or if I look for any big fundamental changes in the company's direction, I may change my position based on that. But I don't try and really trade around earnings. That's a bit of more of a lottery in my perspective, a little bit of gambling. But last quarter, they did beat on EPS slightly, and they also beat slightly on revenue. So it'll be interesting to see what happens here. Their guidance they gave for Q2 was 240 to 245 million with up to 33% revenue growth. Again, they beat last time, so we'll see if it gets closer to that 40% revenue growth again, hopefully. And the full year guidance, it's worth mentioning here. It's for $1.015 billion. $1.015 billion. It's hard to say for some reason. But they actually in Q1 upped that guidance by 50 million, despite having some headwinds related to some of the new advertising laws around apps on Apple iOS and whatnot. So that might affect some of their Create Solutions revenue. I said they think it'll impact the bottom line by 30 million, but they still upped guidance by 50 million. So sometimes when you see this kind of guidance, and then analysts, you see them getting all in a knot if they miss on revenue slightly, and it's like, well, they just upped guidance last quarter by 50 million, and then they missed by 5 or 10, and they're all upset, right? So something to keep in mind. But seeing if they stick it in line with that guidance or if they up it further next quarter will be interesting to watch for too. I always like paying attention to what companies have in store as far as guidance. Analysts are expecting for the full year 2021 to be earnings per share of negative 34 cents. So that's definitely heading in the right direction from previous years. And then for 2022, they're expecting negative 17 cents. So seeing that bottom line improve by about half, and they're actually expecting to reach profitability in 2023. So right now, I think the price to sales ratio is sitting around 30. And that's still a bit high. I mean, we've seen with Unity it trade up to about 50 or even 60 times sales, but it's well off the highs, trading around 30. They've also grown into that valuation a little bit as they're growing revenues about a 40% clip. And that's the nice thing about consolidation period where they're trading sideways, revenues are still growing. You see that valuation kind of come in, right? So they're trading right now on looking at forecasted 2022 numbers at about 23 or 24 times. So that's looking quite a bit better. I'd like to see that number even in the teens. I'd be much happier as far as adding significantly to my position. I would like next year's sales be trading more at like maybe 15 times for this type of company. But in the meantime, while they're trying to reach profitability, they do have a pretty decent balance sheet. They are sitting on $1.65 billion in cash, with only $135 million in debt. So they're in decent shape there. Nice to see also that big money managers managing over 100 million in assets, as well as hedge funds, are still buying up shares of Unity. So this is previous quarter again. So in Q1, we saw that it's in the top 10 holdings in 19 different hedge funds. And there's now 335 funds holding versus only 248 the previous quarter. And we saw new positions in 150 funds, and 126 other funds increased their position. You see much fewer, about half the number, only 62 closed positions versus 150 opened, and only 39 reduced their position versus 126 increased in Q1. So definitely there's been some accumulation there. And hedge funds make up 76% of the shares outstanding. So this is a stock that is now widely held by institutions. So the stock has seen some heat, like it's been executing, but it did get ahead of its skis. It traded up shortly after the IPO last fall to over $170 a share. The valuation got extremely rich, combined with share lockup periods 6 months in, and then the sell-off of some of the higher valuation stocks we saw continued this spring. We saw quite a sell-off into, even as at one time I think it even got here, looking here, down to $76 a share. And since then, we've seen a 50% increase off the lows. So that was, seeing some of those lows were a great time to add. So I did buy Unity shortly after the IPO. It was a company I was watching quite closely and very, very excited about when it came public. And I had a small position. I was planning on adding more, but it just ran straight up. And I actually closed that position at much higher prices than it is today. But then as it started to sell off a little bit, I reinitiated a position lower than what I initially sold at. And I started that in December 31st of 2020 at 152, so much higher than today's levels. Then I bought some more at 132, and then some more at 119, and then I've been accumulating throughout the spring into summer between the 80s and $90 a share. When I see a dip into those double digits, that's when I've been looking to add. And the valuation looks a little better at those levels. So I really like Unity as a long-term investment. And for me, I like to always take that initial position. If it comes in a little more, it just adds to the position, lower my cost basis. But if it goes up, I'm happy I'm already invested in the stock. So for me though, I'd like to be accumulating more shares. If I saw this thing drop into the 80s again, I'd be aggressively buying. It's a more attractive valuation at that point. But I do see a lot of upside in the long term for Unity, especially if they can get back to like sort of that 40% revenue growth rate from 30. But their goal from management is to be a 30% revenue growth beast over the long term. And that's a fantastic growth rate. Nothing to sneeze at. So I'm happy as long as we're seeing that number in the 30% range. And if they can do that, continue to invest in their growth and still reach profitability, that would be by 2023, that would be a huge bonus as well. So a lot to like about Unity. Again, earnings on August 10th on Tuesday, so I'll be watching that closely. And that's all I got for you today. So thanks for watching and happy investing.